All right, good morning, everyone. We would like to thank you for attending our Outlook 2022 webinar in conjunction with LPL Financial Market Research. I'd like to introduce our presenters. I am Burke Sestock, Certified Financial Planner and co-founder of Retirement. I'm also a board member of the National Financial Planning Association, hosting 18,000 members. This is my colleague and co-founder of Retirement, Bill Brancaccio, also a certified financial planner. He is the president of our local Greater Hudson Valley chapter of the Financial Planning Association. Joining us is Vern Hayden, certified financial planner and columnist for International Business Times and author of the book, Getting an Investing Game Plan. Together, we have combined for over 70 years of financial planning and market experience. The theme for the Outlook 2022 is Passing the Baton, as the Federal Reserve and government seeks to hand the economy back to the private sector leadership this year. We will begin with our expectations for the economy. Just going to click through some disclosure slides here and get right to that. So our resurgent economy grew at over a 6% pace in the first half of the year and had one of the best finishes at 5.7% growth for all of 2021. The current economic recovery, which started in May 2020, has benefited from widespread vaccine availability and additional fiscal stimulus. We've had a hand up that has helped us through a period of unique economic challenges. In 2022, the economy may be ready for a handoff back to a greater emphasis on the individual choices of households and businesses. How smoothly that handoff is executed may determine the course of the recovery. The US economy bounced back from its worst year since the Great Depression in 2020, with one of the best years of growth in nearly 40 years in 2021. A combination of record stimulus, a healthy consumer, an accommodative Fed, vaccinations, and reopening of businesses all contributed to the big year. In what amounted to the shortest recession on record, only 2 months in March and April of 2020, the economy came roaring back to produce what is currently expected to be over 5% GDP growth in 2021, more than making up for the 3.4% drop in GDP in 2020. Of course, there have been hiccups along the way. You can't shut down a $20 trillion economy and then expect to get it going again without warming up first. Supply chain backlogs, material labor shortages, and higher prices all held the economy back to varying degrees. The good news is demand is still very strong, and as the backlogs unwind, which could take years in some cases, we expect above trend economic growth and see low risk of a recession in 22. Let's take a look at the economic forecast for 2022. With various measures of output matching or exceeding pre-pandemic levels, it's clear last year's recession is in the rearview mirror, and it may go down as the shortest one in history, even shorter than the 6-month recession from the early 1980s. As the US economy moves more to mid-cycle, our 2022 forecast is for 4 to 4.5% GDP growth in 2022. While a slowdown from 2021, that's still a really solid number. We expect inflation to tame from 2021 levels a little bit above 3%, with core inflation numbers lower, a step in the right direction, although it may still be on an upward trajectory the early part of the year. And certainly we've seen some inflation numbers lately that are eye-opening, but we're paying attention to those. Globally, Europe and Japan were hit especially hard by the pandemic in 2021. But as COVID-19 cases potentially fall globally, those areas could be ripe for better economic growth in 2022. Meanwhile, emerging market economies may disappoint as growth in China could be constrained by regulatory crackdowns. "2021 was the year nearly everything was in shortage, and it all translated to added inflationary pressure. We all remember the photos of people hoarding toilet paper and paper towels. That's just an example of the shortages that we were seeing. Record number of ships waiting at ports, a lack of materials, unfilled job openings, higher commodity prices, a lack of truck drivers, major backlogs and supply chain disruptions all added to larger price increases seen essentially across the board in 2021. While we do believe these pressures will steadily decrease over the next year and inflation will eventually settle back, to 2 to 2.5%, it will likely be a gradual process. Inflation remains near its historic run rate after removing the most volatile pandemic-influenced prices. This more stable measure of inflation has historically tended to pull broader readings of inflation towards it over time. Still, supply chains may take a year or two to be fully addressed, depending on the product and the scale of the problem. Despite challenges around supply chains, hiring, and prices, if the demand is there, it should help drive continued improvement as businesses adapt to address challenges. That is likely to leave us with a positive economic backdrop for at least 2022 and maybe much longer despite current inflation levels. Let's take a look at stock expectations for 2022. And with that, I'm going to hand that over to Bill Brancaccio.
Prospect for above average economic growth and accompanying earnings gains for 2022 point to another potentially good year for stock investors. While the pandemic is not completely behind us and there are several other risk factors to watch for, particularly inflation, stocks have historically done well in this mid-cycle economy. We believe we have started or are in at least the middle of the economic cycle, with a few more years left. Historically, if this holds true, then we believe the chances of another good year for stocks are quite high despite the rough start that we've had for the year. 5,000 would be a nice round number for investors to celebrate. The question is, will that celebration take place in 2022 or later? If we assume the S&P 500 earnings growth improves to around its long-term average of 8% or $235, while the price to earnings ratio, PE, stays about where it is between 5,000 and 51, between 21 and 21.5, the S&P 500 could be fairly valued at between 5,000 and 5,100 at the end of 2022. If interest rates stay lower for longer and support PE multiple expansion, stocks could potentially exceed this target by the end of 2022. But if profit margins face more intense pressure than anticipated, possibly from wage earnings, it may have a hard time growing at all in 2022. So let's take a look at what some of these mid-cycle economies look like. Recession fears do not typically cause stocks to fall in a given year, nor do stocks typically surge as investors celebrate emerging from the prior recession. Over the past 60 years, the S&P 500 index was up an average of 11.5% during the 30 mid-cycle years we identify, with gains in 80% of those years. As you can see, stocks rose during most of these mid-cycle years, with the exception being 1966 and 1977 as the only 2 years with double-digit losses. 2018 came close but did not hit those numbers. The Fed, which we expect to start raising interest rates as early as this year, can help us gauge the cycle because central banks typically begin raising rates when the economy is exhibiting mid-cycle characteristics. That characterizes 2022 as likely a mid-cycle year. Historically, stocks have done well during the first 12 months leading up to the Fed's initial rate hike, with gains in each of the past 9 instances, an average gain of 15%. We expect stocks to follow this mid-cycle pattern and potentially deliver double-digit gains in 2022 as the economy continues to expand at a solid pace. An expanding economy is also a great start for stocks, fundamentally derive their values from earnings. Stable profit margins and increasing share buybacks made double-digit earnings growth for the S&P 500 a possibility in 2022. However, COVID-19 related supply chain issues, material and labor shortages could lead to higher costs this year. That could potentially weigh on profit margins. As a result, we are forecasting slightly below average S&P 500 earnings growth of 6% in 2022, or $218 in the S&P 500 earnings per share. Higher corporate taxes could also potentially eat into some of those earnings gains next year. Now, we're going to take a look at what we expect for the bond market, and I'm handing it over to you, Vern.
Thanks a lot, Bill. For 2022, near-term inflation expectations above historical trends and improving growth expectations once the Omicron variant recedes are reasons why we believe interest rates could move moderately higher from current levels. In 2022, we expect the 10-year Treasury yield to end the year between 1.75 and 2%. However, an aging global demographic that needs income, higher global debt levels, and an ongoing bull market in equities, which potentially means more frequent rebalancing into fixed income, may keep interest rates from going much higher in 2022. While we don't expect interest rates to move much higher next year because starting yields for core fixed income are still low by historical standards, returns are likely to be flat to low single digits in 2022. Not a great year, but we should see an improvement over the negative fixed income returns we have seen in 2021. With long-term interest rates close to what we think will be cycle highs, it's important to revisit the case for fixed income within a broader asset allocation. Core bonds have historically provided capital preservation, diversification, and liquidity to portfolios, which we think are important portfolio construction objectives and helps clients remain committed to their investment goals. With the economy likely transitioning to mid-cycle, the need for high-quality bonds increases in our view. Moreover, the need to offset potential equity market volatility remains an important role for core fixed income. Bonds, particularly core bonds, have been less volatile than stocks and have historically provided ballast to portfolios during equity market drawdowns, which, as we know, are normal occurrences from time to time. The maximum drawdown for bonds in any given month has been dramatically less severe than stocks. While the worst drawdown in a month for equities was minus 28%, the worst bonds have done during a month was down 6%. And those losses were quickly reversed. So when combined with equities, bonds help reduce total portfolio volatility, which makes for a much smoother investment experience for clients. So what's next for credit? As the economy transitions into mid-cycle credit, investors need to be more cognizant of downside risks. While the economy should still be conducive to credit risk and corporate balance sheets generally should be remaining in good shape, credit spreads are among the lowest they've been in years, which means compensation for the added risk of corporates is low. Both investment-grade corporate credit spreads and high-yield credit spreads are in the bottom 5% compared to history, which means valuations have been cheaper 95% of the time over the past 20 years. Corporate credit markets, both investment grade and high yield, are currently priced near perfection. So any unforeseen event, either related to the economy or at the corporate level, could negatively impact credit markets. We remain neutral on investment grade corporate credit, but we think equities continue to offer better upside return potential than high yield bonds, where we remain underweight. For income-oriented investors willing to take on more risk, we think bank loans still make sense where appropriate. Federal, state, and local governments, usually better suited for the role of timekeepers or race officials, have run a strong leg for the economy over the last 2 years. No one would find this level of government involvement ideal under anything close to normal circumstances, even if it was necessary to some degree in the face of the pandemic. But the private economy was by no means on the sidelines while this was happening. While some service-based industries were devastated by the pandemic, businesses on the whole innovated, adapted, and evolved. They have positioned themselves well to take the handoff and run the next leg, and our market views reflect that. We are watchful of the risk associated with government passing the baton in 2022, but we believe that ultimately the economy will be healthier while still managing to create opportunities for investors. Back to you, Bill.